So today we're going to talk about the future of Social Security. And we'll dig into that after the slot updates and the market updates. And again, if you're joining us on YouTube, make sure that or via recording, make sure you hit the subscribe and like and notification button. And I always love comments. So fill in those comments and let me know what you think of this webinar. All right, so let's start with the slot updates, and I'm going to share my screen here with you. So I'd love to be able to ask if you can see my screen, but I'm just going to have to guess that you can, and I can actually see that you can. So we're going to run with that. So you can see here that this first mailbag report. So the slot mailbag is when people write in with questions, and then the team from either Ed himself, I haven't seen Ed respond to a letter in some time, but either Ed or his team responds to the letters that come in, either from the public or from financial advisors, CPAs, attorneys, all sorts of folks. So this first question is from Ian Berger. Ian responds to it, and the question is, hi, thank you for all the helpful insight on retirement. I wish I heard about your website earlier. I turned 72 last year and followed your advice on QCDs, qualified charitable distributions, but don't know how to claim it. So this is really common with QCDs are getting more and more common, and people have questions about, okay, now how do I get notified? So this person's asking or says, my RMD required minimum distribution was $50,000 in 2022. I did a QCD of $10,000 and then withdrew my $40,000 by the end of 2022. So this person captured their entire required minimum distribution. 10,000 of it went directly to a charity as it's required. It has to go direct to that charity. I'm assuming that's what they did. And then they took a distribution for themselves for the remaining $40,000. And he writes, or she writes, my taxable amount should be $40,000 and not $50,000 as listed on the 1099-R. How do I reflect that in my tax filing? Thank you for your assistance. Ellie, so first thing that I would tell you is I'm going to answer this, but from my point of view, don't forget you want that team in place. You want that team that is helping you and watching over and working together. So a CPA, certified financial planner, and your estate attorney at a minimum. You might want other attorneys, but you wouldn't run into these issues and potentially cause yourself issues if you had that team in place. So that's important. So Ellie, let's see if Ian answers here, and my folks aren't answering me. But Ian answers, hi, Ellie, thanks for the kind words. This is a question that trips up a lot of people. That's because custodians are not required to indicate on the 1099-R which part of the annual IRA distribution was a non-taxable QCD. Instead, it's up to you to show that on the 1040. In your case, enter $50,000 on line 4A, IRA distributions, but only $40,000 on line B, taxable amount. You must also enter QCD next to line 4B. Tax preparation software should handle that for you. So that's a really great little nuance with these things that are, really becoming popular, as I said, and are so important. So the next question is there a limit on the number of IRA rollovers you can do in a given year? Are the rules different from trustee to trustee transfers? So let me read that question again. So the next question is there a limit on the number of IRA rollovers you can do in a given year? Are the rules different for trustee to trustee transfers? Thanks, Paul. So the answer, Ian writes, is, hi, Paul. Yes, there is a limit. You can't do a rollover of a distribution that you received within 12 months of a distribution that you previously rolled over. That's called the once per year rollover rule. Be very, very careful. People get tripped up on this all the time, so be careful. This limit applies across all your IRA accounts. It applies to traditional IRAs, to traditional IRA rollovers, and Roth IRAs to Roth IRAs, but not to company plan to IRA rollovers. IRA to plan rollovers, or traditional IRA to Roth IRA rollovers / conversions. You can avoid this rule entirely by doing trustee to trustee direct transfers rather than 60-day rollovers. There's no limit on transfers. So the moral of that story is just never take that check. Never take that check payable directly to you. Try to do that 60-day rollover. That trips people up all the time. So don't do that. So don't take that check directly to you if you can avoid it. don't try to get cute with a 60-day rollover, that temporary loan, things like that, because people get caught up often. All right. The next is RMDs, RMDs and employer plan contributions. So this is from last week. So we're catching up a little bit, because we missed last week. And this is by our friend Sarah. You all have met Sarah, as you have Ian. The question is, I am interested in your interpretation of the RMD, required minimum distribution rules, using the following facts. The original IRA owner's date of birth is January 21st, 2029. Original IRA owner's date of death is 12/29/21. IRA non-spouse beneficiary date of birth is 7/21/54. No RMD was taken in 2022 by the non-spouse beneficiary. Does the beneficiary have both a 2022 and a 2023 RMD that can be taken in 2023? So, you don't have to really worry too much about the facts other than the original IRA owner's date of birth, right? And that's going to then reflect how old he or she was when they died. And then the original date of death will tell us if they, they certainly, the first one will tell us if they crossed that required beginning date. And the second one will tell us, if that RMD is likely due for that year. So, the answer for Dale is the Secure Act would apply to this inherited IRA. Under the Secure Act, most non-spouse beneficiaries are subject to a 10-year payout rule. Additionally, the IRS proposed RMD regulations require RMDs to be paid during the 10-year period if the IRA owner died after his or her required beginning date, RMD required beginning date. That appears to be the situation here. And they're basing this off of the age, of course. However, the beneficiary would catch a break on the missed 2022 RMD because the IRS waived the penalty on these RMDs due to confusion over the new rules. That relief does not extend to 2023, so an RMD would need to be paid for this year. That also only applies to inherited IRAs. There was no relief in 2022 for regular RMDs, just for inherited IRA RMDs, because we got conflicting and confusing information from the IRS, and they acknowledged that and said, don't worry about it. Don't worry about 21 and 2022 because we gave you conflicting and confusing information. So the next question, my granddaughter, age 28, has a Roth IRA created from money earned from previous menial jobs. In 3 years, she will complete her residency, and as a radiologist, her earnings will be substantial, and most likely she will not be eligible to contribute to a Roth IRA. Would her earnings also prevent her from continuing to contribute to a Roth 403B through her employer? So Noreen's granddaughter has a Roth 403B plan, could also be a Roth 401k. And she's asking, well, is she going to earn too much now as a radiologist to contribute to that Roth retirement plan, 403B or 401k, in this case, the 403B. And this is so important because I see it in classes, and it's really great to see people live again because you see their faces, and sometimes you see the confusion in their face, which you can't do on a webinar. But when we go through, we talk about Roth IRA contributions, and there's income limitations. But with Roth retirement plan contributions, there are no income limitations. So Noreen's granddaughter could make $1 million a year and still be able to contribute to her Roth 403B. So I know Sarah got this answer right, but let's just follow through with it. Good news for your granddaughter. While Roth IRAs are subject to income limits, which prevent higher earners from contributing, Roth employer plans like Roth 403Bs have no such limits. Her increased earnings will not preclude her from continuing to contribute to the Roth 403B. Great answer. And I love retirement plans because the contributions, like I said, first of all, they're much greater, right? Increase substantially under, with the inflation adjustment for retirement plan contributions for this year, but allows you to put more away, and also there are no income limitations. So really great information. So let me switch back to just me, and we'll move on, and we're going to talk about the markets. So I'm Going to first talk about the close of last week's market. So the Dow Jones Industrial Average, you all, if you were paying attention at all, you saw that the market had a big downturn last week. Then the Dow Jones Industrial Average was down just about 3%, 2.97%. That brings it down year to date 0.69. The S&P 500 was down 2.66%. That brings it the return for the S&P 500 a positive 3.65. The NASDAQ was down 3.31, still positive for the year, 9.02. The World Index, MSCI World Index, not including the U.S., was down 2.41 for the week. It's still positive 4.83 for the year. The emerging markets were down 2.74. They're all in that range, 2.74, 2.4, 2.61, 2.33. And everything is still positive for the year except, and this is as of Friday. Don't forget, we had a good day yesterday. I'm not sure. The opening started positive when I looked at it, but that's been, almost an hour now. So everything's still up for the year, anywhere between 9.02% to 1.72%, except for the Dow Jones Industrial Average, which is down 0.69. The bond index, all the bond indices were down last week, but most of them still positive for the year, with the exception of the 1 to 3 year bond index. The 6-month Treasury was up again to 5.09 over 5.01 the week before, up from 4.75 from the end of the year and up from 0.64 just 1 year ago. So the 6-month U.S. Treasury went from 0.64 on 2/24/2022 to 5.09 on 2/24/2023. So that should give you some indication about how rapid interest rates have increased. And I was watching, as I was preparing this morning, I had CNBC on in the background, and they said Jim Cramer was saying, and Jim Cramer, he's an entertainer, let's be honest, but he was saying, what has it really done? What have these rate increases really done? We're still seeing high inflation. We're still seeing rents have slowed a little bit, but we're still seeing significantly high inflation and really not much cooling that we want to. So that's concerning. Okay. And what are some of the analysts saying? So BlackRock doesn't say much this week. They're talking about value stocks over growth stocks a bit. So growth had a really great run over the last decade or so, and value companies seem to obviously be in a better place right now. But they do right. We think value stocks can outperform as interest rates head higher. Regions and sectors help us find quality within value and growth at a reasonable price. Again, not saying much from BlackRock this week. There's an interesting piece from Prudential. Well, now it's Empower. I've shared with you that I just find this entertaining, the way this fellow writes. But he wrote about the economy and what we don't know about the economy. So he started with who recently said the following was his quiz. There's a lot we don't know about the economy. Was it A, Kim Kardashian, B, Kim Jong-un, C, Walmart CFO J.D. Rainey, or D, every economist in the Western world? And he goes on to write, if you answered E, all the above, you get a gold star, not only for getting the right answer, but for thinking outside the box. All right. So the moral of the story here is that there is just a lot going on in this post-pandemic economy that doesn't make much sense. That I just talked about, the Fed aggressively raising rates, not much cooling going on, which gives us the feeling that these rates are going to increase and increase and increase. And there's not really going to be any easing. And what is that going to do to the markets? What's it going to do to housing? What's it going to do overall? So that's obviously concerning, right? We've talked about, and you hear, if you listen to any of the financial networks or read anything, they talk about this soft landing, and doesn't that sound great? We're going to raise rates and come out of this very easily, and you got kind of this, nice fluffy bed to land on. And it's not likely going to be that way. It's at some point the Fed has to push and push and push, and we're going to see likely a significant drop economically across the economy, and therefore across the markets. So, so there's a lot of confusion around this, post-pandemic economy, and really what's going on doesn't make a lot of sense. So Walmart CFO John Rainey said, and he's not quoting here, he said something like, when he and his colleagues were discussing the Walmart's quarterly earning results a week ago. What did he say here? I'm sorry. Oh, he basically said there's a lot going on that they just don't understand. So that was the comment. There's a lot going on in the world that they just don't understand. So when you're talking about someone like the CEO of Walmart, who's really should be in the trenches of understanding he's got a lofty position within still the world's largest retailer, notwithstanding Amazon, but he's getting certainly the information from the folks that he surrounds himself with and who work with him. But they use the analogy of taking your car to a mechanic or to your dog to the vet and hearing something like, "Yep, something." I'll just read it to you. "Yep, something's for gosh sure wrong, but I'd be darned to know what it is." And that's kind of what the CEO of Walmart is saying, and economists are saying that there's something going on here, but we're not really sure what it is. There's a lot of conversation around it, but who knows what's causing it. And listen, I've told you before, here are my thoughts. When we're looking at what's going on in the economy, we've got people are trying to align it with other times in the history of our nation, history of the world, right? Economically, from an economy point of view. So they like to talk about the Great Recession. They like to talk about the Depression. They like to talk about the 1970s and the late 60s, and even coming out of World War II. You're starting to hear a lot about coming out of World War II and what that looked like. But the difference today is we have over 70 million baby boomers who are stopping working, choosing or having to retire, starting to claim Medicare benefits. We're going to talk a lot about Medicare and Social Security today. So starting to claim benefits, not paying into their payroll, concerned about their investments and making decisions based on that, maybe adjusting their spending. Don't really seem to be, but maybe at some point they're going to adjust their spending. So that's the big difference to me. Now, I am no great economist or anything like that, but it seems obvious to me that this is the big difference. Is you've got a large number of people who are making this migration, and that, of course, is going to affect the economy. All right, so we're adding MFS back into the picture. It used to be called Buy the Numbers, and they've actually changed to something else that's still BTN, but I can't remember what it is right now. But they talked about rents. Rent rates in the U.S. are rising at the slowest pace in over a year and a half. According to Redfin's monthly rental market tracker, the median asking rent increased 2.4% in January, which is the smallest increase since May of 2021. In 11 U.S. metro markets, rents are already falling on a year-over-year basis. That's the first time we've heard that, and obviously in a couple of years. The next piece says 3 years already. February 19th, 2023 marked the 3-year anniversary of the U.S. stock market's pre-COVID high, using the S&P 500 as a tracking proxy. The S&P 500's annualized return from 2020, so February 19th, 2020, through February 15th, 2023 has been 8.59%, which is lower than the 15.03% seen in the 3 years leading up to the pre-COVID high. And you might remember that I shared with you that Vanguard came out with a report a short time ago that where they had their 10-year projections, and their 10-year projections were very, very modest. So for the markets, the U.S. markets. So they were working from memory here, but I seem to think they were in the range of 4 to 6%. Now that's significant because previous projections had been 10, 11%, 12%. in the past, not, so this is a big shift and something to be concerned about, because a lot of our decisions are made on our past experiences, not necessarily looking forward at what could happen. And it's been, I was speaking with, I guess it was my wife early this morning about the growth. So that's funny, right? Growth we've experienced over the decades. And I said it's been very easy to have growth over the past decade and a half. And people take that for granted. So they take it for granted that they can just choose an ETF or an exchange traded fund or a mutual fund or individual stocks for that matter, and they're going to have the same kind of growth they've had in the past. The difference is, of course, the folks we live with at some point, very soon or now, they have to start living off of this money. And that's a difference. So record debt on the horizon. We're going to talk a bit about this Congressional Budget Office report that MFS talks about here, but the latest budget and economic outlook from the Congressional Budget Office paints a worrisome picture of the United States' future finances. By 2023, federal outlays will represent just under a quarter, 25% of GDP, gross domestic product, while revenues will only amount to 18.1% of GDP. So federal debt in 2033 will reach 118% of GDP, the highest level ever recorded. So that is concerning, 2033. And that's why we talk about, if you're going to take steps to be tax efficient, and I think most people should, then you better do that by 2030 or very shortly thereafter, because that train is coming. People often talk about estate tax. So what about these other taxes that we can apply? And MFS has a nice little segment here about minimal impact of estate tax. For all the attention it gets in discussion of tax reform, estate and gift taxes have a negligible impact on federal revenues. According to the Congressional Budget Office, federal revenues from estate and gift taxes in 2022 accounted for less than 0.1% of GDP. So 0.1%. Even when the provision for the 2017 Tax Act that doubles the exemption. So let me just pause there for a second, because when I said that the estate tax and gift tax in 2022 accounted for less than 0.1% of GDP, you might say, well, okay, well, the estate tax exclusion is over $22 million. And how many people have $22 million? But we know that it reverts back to 5 million. Yeah, I think it's 5 million off the top of my head now. At the end of 2025, and that's based off of the sunsetting of the Tax Cuts and Jobs Act. Some people call them the Trump tax cuts. So everything rolls back to 2017. That exemption amount expires. So the revenues from estate tax and gift taxes are projected to remain close to 0.1% of GDP. So even though that significant increase in the estate tax exemption, right? The amount that you can pass on before you apply any estate tax, even though that gets cut dramatically, then we're still at 0.1% of GDP. So it doesn't move the needle, as we say. Higher interest burdens. According to the Congressional Budget Office, the CBO, net interest outlays on federal debt rose 35% last year, and are expected to rise another 35% this year to 2.4% of GDP. So we've increased the debt, interest rates are going up, all those reasons causing this interest outlay from the debt. Interest outlays are forecast to double from $739 billion in 2024 to $1.4 trillion. Relative to the economy, that would represent 3.6% of GDP and the highest level since at least 1973. Not a great picture, folks. All right, I'm going to pull up my whiteboard. I'm going to share that. So I'm hoping you can all see my whiteboard. Make this larger. And if you're just joining us now on YouTube, we have two different segments. So we do the full Tuesday weekly webinar. It runs about 45 minutes or so. And then we also do the Financial 15, which is the approximate 15 minutes of this last segment, which is the financial planning topic. Today's financial planning topic is the future of Social Security. And again, if you're just joining us on YouTube, please hit that subscribe, like, and notify button so that you are notified when we schedule these and when the recordings are available. So we had two significant reports. So we had the U.S. Treasury report. That was February 16th, 2023. I'm right here. Let me position this so I can draw on this thing. And then that covers the fiscal year 2022. And the big news in this was, and I'm sorry, the other one was the Congressional Budget Office report, which we're going to go over in a second. And you do see, I've got some nice reports over here on the side. And if you see me looking down, I'm drawing on this pad. So, I'm not like checking my text messages or anything like that. All right. So the first is the U.S. Treasury report. And I'm not going to bury the headline here. The U.S. Treasury reports that the government is on unsustainable fiscal path. So this isn't the first time it's been reported this way. They continue to tell us this is an unsustainable fiscal path, but the unsustainability keeps increasing. And we're going to talk a little bit about politics here in a minute, but I'm going to share with you first what's going on and what's causing this unsustainable fiscal path. Some steps you can take to protect yourself. And geez, I just wish that Washington would get, to kind of get behind it. But you know what? We as a whole, as a country, have to get behind it too, because let's talk about politics first. And then I'll come back to it, because anytime, and I use this example in my class and I've been using it for years, and it happens to be focused on Republicans right now, but it's been focused on other parties in the past, Democrats in the past. There were some senators who said they wanted to potentially change Medicare and Social Security. So now this is a political football that's being used, against them in elections. And that's just what happens. So this is what they call the third rail of politics. If you happen to mention that Social Security is underfunded, Medicare is underfunded, and we should do something about this, then you're nearly guaranteeing your loss of your position. And that's unfortunate, because Social Security is underfunded, Medicare is underfunded, and we have to do something about it. But politicians have to have the courage to say it. And we as Americans have to have the courage to stand behind it. Now, I am not saying cutting benefits or anything like that. I'm saying that, look, for our generation, we're likely, so the Generation X and Generation Y and the ones after us, we're probably going to have to make some changes. So I'm getting ahead of myself, getting on my soapbox a little bit, but let's talk about what builds it up here. So spending versus revenue. So here is our spending for fiscal year 2022. Remember, this is fiscal year 2022. Spending equaled $21 trillion. Now, that's an increase of 23.8%, an increase of $1.7 trillion. Really significant, right? So that's a big increase, 23.8% year over year, from 2021 to 2022. So there are some things that you can blame it on. There were some adjustments to pension payments to the VA and the Department of Defense and things like that. But you can't say this is directly related to the pandemic. Some of it is the pandemic, but we're coming off of that pandemic kind of push out, right? That $9 trillion that we pushed out. Revenues. So here's our spending. Here. Revenues. And of course, that is mostly, and we're going to show this, but mostly tax, right? Revenues were $4.9 trillion. That was increased as well, increased by $670 billion. So we had more tax collections in 2022 than we did in 2021, but that was just an increase of 15.7. So going back, if you treated your business or your household like this, you wouldn't be in business, or you wouldn't have your household for long. But the federal government treats it differently. So let's look at the spending. I'm going to shoot over here, and I'm going to increase this chart for you, just because I thought this was interesting. So here's a good pie chart of where the spending is. So you've got the Department of Veterans Affairs here at 21%. You've got Department of Health and Services here, Department of Defense. You got your Social Security Administration here, Department of Education, Department of Treasury, interest on the national debt, and then all other, right? And that equals $9.1 trillion. So I just share that with you because, there's not a lot of area for reductions here. Everything's kind of around the fringes. So we really do need some kind of vast overhaul. And I'm really thankful I'm not running for office, because somebody would be capturing this video right now and certainly be using it against me. But I thought this was interesting, this pie chart, for you to look at, because I found it interesting as well. But, we don't see, we talk about our class that 101% now of our revenues. And when I started teaching the class, I think it was 96% or 94%. I don't recall. But now it's 101%, which means we're borrowing a portion, right, to fund these, and that's Social Security, Medicare, Medicaid, and interest on the national debt. So it's getting away from us, folks. So let's talk about that. So that is expenditures. Let's talk about revenue breakdowns. So we know the revenues, right? Remember, we carried this down. It was 4.9 trillion. I'm up here, and I carry this down here to 4.9 trillion dollars. So where does that come from? Well, 530 billion of it, or 11%, comes from other revenues to the federal government. That's fees, Federal Reserve earnings, excise taxes, customs duties, etc. 383 billion, or 8%, comes from corporate taxes. So where does the rest come from? Where does the 81% come from? Well, no big surprise here. 4.2, I have billion, trillion. That should be trillion. $4.12 trillion comes from individual income taxes. So that's a problem, right? So we have a heavy reliance on individual income taxes. That's what drives the U.S. government. So take a look at this here. Where's my expenditure or my revenue chart? There it is. And you can see how that's changed over the years since 2018 all the way today to 2022. So you've got these little slivers here that are corporate taxes and other expenditures. And then this huge amount here, $4.12 trillion, not billion, but $4.12 trillion is individual taxes. So you have to ask yourself, when the government goes to increase revenues, where are they going to go? Well, yeah, hopefully they're going to go here, right? Increase corporate taxes. That's okay. But how much can, if they double this, if they double the corporate tax rate and they double corporate taxes, that still keeps us under $1 trillion, and we still have to handle the lion's share of it. So I hope graphically that makes sense, and certainly by the numbers that makes sense. So this is, I hope you see here, this is what brings us back. I listed that headline twice because it's just so important, and it's an unsustainable fiscal path. So again, if you want to read this report, so this is the executive summary of the Treasurer's report, right? So this is only the executive summary. So it's just 10 pages. You should go through. I went through it and read it. If you're serious about your retirement plan and you want to understand what's going on with the country, you don't have to read the 200 pages that they put out or whatever it was. I think it was at least 100 pages, but the 10-page executive summary makes sense. So you should go through that. So I just kind of picked out some parts of it that I thought would benefit you, and give you some understanding of what's going on and why this is an unsustainable fiscal path. And again, we're going to be told this over and over again until something changes. And then a couple of days later, we got the Congressional Budget Office report. So let me switch back here. The Congressional Budget Office report, that was on, okay, come on, stay with me here. Why is that doing it? Okay. Congressional Budget Office report, that was February 15th. And I'm going to just read to you. I pulled some excerpts out of there, and it says Congressional Budget Office's February 15th Budget and Economic Outlook found that without government intervention, the Social Security Administration Trust Fund will become insolvent by 2032. So do you remember what the Social Security and Medicare Trust Fund report said last year? Well, you don't have to. I'll share it with you. It was right here. It said 2034. Now, with disability included, right? So that's old age, security income. I forget that S, but this is Social Security. This is Medicare. and this is Social Security plus disability. So this was scheduled to run out in 2034. So that's been changing around that number a bit, but the Congressional Budget Office says it is now 2032. We won't get another trustee report until at the earliest, I would say May, June, but I think it's more like October when we'll see it. And then you see here, Medicare is scheduled to run out. That's the trust fund. It's depleted. So the trust fund goes to $0. And then there's only a certain amount that is left to pay for benefits. So should the trust fund be depleted, and talking about the Social Security trust fund here, Medicare is obviously much sooner. In 2032, if Social Security trust fund is depleted, then there's only enough to pay 75 to 80% of scheduled Social Security benefits. So it's very, very unlikely that the government's going to allow that to happen because, again, it's just political suicide, right? If suddenly anyone has to stand up in front of you, the president, the Speaker of the House, the leader of the Senate, stands up in front of us all and says, hey, listen, we have to cut. We've known this has been coming. They're not going to tell us that because they don't tell us the truth. But and I know I'm being cynical here, but I think it deserves some cynicism. If they stand up in front of us and say, hey, you current Social Security folks receiving Social Security, we're going to cut your benefit by 25%. It's not going to be good. So we do have to look for answers to that well ahead of time, and we are running out of time. Okay, so let's talk about politics. So the politics of it, we've talked about. We really need people to have courage, not only our elected officials, but ourselves, to be able to support the idea of making changes to these programs. And I'm not saying abandoning the programs. I'm saying making changes for future generations so that we can keep ourselves solvent. We need to I'm just talking about Social Security and Medicare. We also need to address the national debt because very, very soon, and I'm actually going to talk about the debt. I'm planning to talk about the debt by itself next week because it demands its own conversation. So very, very soon, we'll be at $1.4 trillion a year just servicing our debt. So you can see, you saw what our revenues are, just over $4 trillion. Most of that comes from us. It doesn't come from corporate. It doesn't come from fees. It doesn't come from those things. It all comes from us. So we've got to have the courage to put that that fear mongering aside and be able to have some real reform and not get caught up in what the politicians are saying, not let them, use this as a political football because it's the future of our country for our children, our grandchildren, et cetera. So I know, again, I'm on a soapbox here. So what's your next steps? Well, of course, how can you deal with it yourself? Well, aside from driving to Washington and becoming an advocate, a peaceful advocate, then review your plan. Make sure that you're set up. Make sure you're taking these things into account. Read the reports if you'd like to, or listen to this webinar again. Listen to other folks. Plan by generations. So what does that mean? So, as I talked about with Social Security, I would be as a Generation X person, I'm 54 years old. I'm probably 15, 16 years from retirement. I would be 100% fine with saying, the earliest retirement age that I can collect is 67 years old, and for my generation. And full retirement age is say 70. And if you wait until you're 75 or 76, whatever the math works out to be, I haven't done the analysis of what needs to happen to help fix Social Security, but it's something like that. And of course, wage increases, so we only contribute up to a certain amount to Social Security. Of course, that should be increased. We have to help inform our next generation. So if we have children or grandchildren, we've got to let them know about these things because there's one thing that is consistent in all my time teaching classes, sitting down with individuals and bringing information to them. Never once has anyone said, oh, geez, I really wish I would have waited a while longer to hear about this or do this work or get started in this. No, of course not. Everybody says, I wish I would have known about this 10 years ago. So we've got to educate and help inform the next generation about these problems because I guarantee you the next generation is not well, not many of them are reading these reports or paying attention to it. They don't know the costs of out-of-pocket costs during retirement when you start receiving a Medicare benefit. They don't know that up to 85% of your Social Security can be taxed. They don't know that it's likely that you're going to spend just as much, if not more, during retirement than you are your working years. They're still caught up in these paradigms, if they're even paying attention, that we were all taught for 40 years that we know now are wrong, and should have been handled other ways. So review your plan, talk to the next generation, plan for generations, tax efficient planning. Of course, take care of yourself. Make sure that you're shifting money as you should. We've got our 3 buckets. You've seen me do it a million times. You've got your taxable bucket, your tax deferred bucket, and your tax advantaged, or you can call it tax-free bucket. So you want your mathematically ideal amount in each one of these buckets. And then you want everything else to be in this bucket, because when it hits the fan, if you have everything shifted over already, at least you and your family, your loved ones, and unfortunately, it's just going to be a small percentage of you, still, at least you're going to be insulated and protected. So it's very, very important. Investment planning. You've got to think about not always looking through things with the rosy glasses or the rose-colored glasses. We could be in a very long, difficult time. The next year and a half, 3 years, 5 years could certainly be the case. Now, you don't want to be pessimistic. You want to be defensively optimistic, but you want to set up your investments so that you can have growth, but make sure that your needs are taken care of. So the answer to that from listening to me or watching me on these webinars or hearing me in person. It is that the 3 pillars of investments, and I'm really adding a 4th, but you've heard me say this. So it's asset allocation. Make sure that you've got a strong model allocation across all of your investments. Make sure your components are strong. I'm still hearing people that are investing in age-based portfolios and just kind of letting it ride. And that's no good, folks. You don't want to be passive here. And I'm not talking about, when I say passive, it's fine to use, you hear about passive and active management. It's fine to use passive investments like exchange traded funds, in the right places. They're cheap and efficient, and they're all good. I'm talking about your attention and focus. You don't want to be passive there. Principal protection. Make sure that you've got a portion of your investments that are going to potentially earn you some nice return, but are also principal protected. So you can't lose any money in any given year. Account segmentation. Goodness gracious, this is the most common sense approach that almost nobody does to how your funds should be positioned. And you've all have talked to me or heard me talk about it before. If you don't know what the heck I'm talking about, go to AttleboroWealth.com, look at our investment strategy, and there's a video in there that talks about the 3 pillars of investing, and adding that 4th pillar of guaranteed lifetime, and ideally tax-free income just wraps it all up. So it's really important that we pay attention to what's going on, be aware of what our leaders are telling us. The government is sending us this information. They give it to us all the time. They've been doing it for decades. We have to pay attention. We can't have our head in the sand. All right, I'm just 5 minutes over, but that's kind of the norm these days. I can't see if there's any questions. I apologize for that. If you have questions, email them in. And I'll be happy to answer them individually. If you want to schedule time to see us or see me, you can reach out to admin or questions, either one. They go to the same place. So admin or questions at AttleboroWealth.com. If you haven't subscribed yet, please subscribe so you don't miss these notifications or miss these videos. As always, I'll be sending this out to you if you're on my email list, the recording of this. If you want to be on that email list, send me an email. Admin at AttleboroWealth.com. We'll add you to the email list, so you'll get the recordings of these webinars. You never have to miss it. Otherwise, have a great week, and I'll talk to you all next week.